Good afternoon. I'm Damon Silvers. I'm the policy director of the AFL-CIO, America's Labor Movement. I'm here at the offices of the Friedrich Ebert Stiftung in New York City with my good friend, Professor Joe Stiglitz from Columbia University. And we're here to talk this afternoon about banks, financialization, and the role of bank workers. I'll just say a word before asking my friend Joe to start talking about why Joe's with us today. There are very few people who have done more in the global debate about the role of banks and finance since the crisis than Joe Stiglitz. Joe has been a powerful voice for the idea that the financial sector should be a servant rather than the master of the global economy. And so for that reason, it's really a great honor and privilege to be able to talk with Joe this afternoon. Joe, let me begin by sort of turning us back a little bit over the last 10 years and just ask you to say a few words about why do banks matter? Why is this more important than, say, talking about pharmacies? And talk a bit about your experience with the interaction of banks' economic and political power with the processes that regulate banks.
So why do we need financial institutions? I mean, one of the important assets, resources of our society is capital. And a well-functioning economic system has to allocate that capital, decide where it goes to have the highest returns, to manage risk, a whole set of functions without which no economy can really work well. The problem is that our financial sector hasn't focused on its important social roles, but has asked a narrower question: how do I make as much money for myself as I can? So there are many ways, it turns out, to make money with money that are quite different, in fact, contrary to the social function which they're supposed to do. Let me give you some obvious examples. The banks naturally run or are connected with the credit card system. People need credit cards to buy things. That's part of the medium of exchange, as we call it. But once they had control of that, they realized they could do two things. One, they could engage in abusive credit card practices, charge late fees, overdraft fees. And when I talk about this, it sounds like a little money, but we're talking about billions and billions of dollars. And then they can charge not the market rate of interest, which a competitive rate of interest, which might be 2, 3, 4, 5%, but 20 or even 29%. And that is a gold mine. And we're talking now about tens of billions of dollars a year. So what this means is that they're actually interfering with the functions that they're supposed to serve society, and they're actually hurting the people at the bottom in particular, those who don't really, aren't financially sophisticated, don't understand they're engaged, let me put it very bluntly, they're engaged in exploitation of anybody that they can. Those who are less financially literate, are easier to exploit, but they engaged in market manipulation, in foreign exchange markets, a whole set of markets where there are very sophisticated people, but they have inside information, and so they can exploit even very sophisticated people. And so what's going on here is just exploitation, and they're in a position to do that rather than to serve society.
Joe, let's pick up on this theme of information for a moment that you're emphasizing. In a world of big data, where it's easily possible for large institutions to have huge information advantages over everybody else, including sometimes government, how do we think best about the ways in which the financial system and the banking system within it can be effectively regulated? who has the information, who has the resources necessary to be able to steer the financial system more toward the valid public purposes you were describing a few minutes ago?
Well, the problem is it is actually very difficult to regulate the banks. And when we talk about regulation, we really want to do at least three things. We want them not to abuse ordinary citizens and engage in all that kind of market manipulation, to behave in a competitive manner. We don't want them to engage in excess risk-taking in the way that they did that led to the financial crisis that cost us trillions of dollars. And most importantly, we want them to serve our society. The first two are just stopping them from harming us. And to me, what's so remarkable is how much the focus of attention in the last 10 years is stopping harms. When the key thing is, how do we make sure that they actually do what they're supposed to do? So we want all three of those things. Now, information about what they're doing is difficult to get. I mean, that's the whole point. They know that we don't know. And they therefore engage in a lot of secretive activities. They make a big deal about, they may talk about transparency, but their real game is lack of transparency. Among the people who actually know what is going on are the people in the banks themselves. You talk to some of the people who were actually very senior people in the banks before 2008, they will tell you that there was no way that the banks knew what the risks were that they were undertaking. So here are the workers in the banks openly admitting to me that there was no system of controls on risk, no human way by which they were, they were organized in a way that no human could ensure that they were behaving in a responsible way. But it also was the case, talking about the Wells Fargo incident where they were opening up accounts for people who didn't want them. And now, those individuals didn't often know that accounts had been opened up and they were draining money out of it. But clearly, the regulators didn't know about it. Other citizens didn't know about it. But the people who were opening up the accounts knew about it.
Yeah. And that's a very interesting example, Joe, because at Wells Fargo, as an environment came into being with the help of some of the unions trying to organize bank workers, where bank workers talked to each other, that they realized that collectively they had been involved in something that they didn't want to be involved in. And 20,000 Wells Fargo workers signed a petition saying, we don't want to be managed in this way. But it was very one-off, and those people were vulnerable when they did so. They didn't have a lot of protections. How do we think about creating an environment in which bank workers can be heard, given what they know and given the fact that they often don't want to be involved in exploiting their customers? It's not what people want to do when they go to work, at least most of us.
Yeah, well, I think there are probably three parts of this. One is, it is really important to have whistleblower statutes to say, if I as an individual see something that is really outrageous, I can go to a public official and say, they're violating the law, I don't want to be part of it, I want to have respect for myself, and they won't be fired. We have those laws, but they're not really adequately implemented, and they're mostly in the public sector, not in the private sector. The second thing is the unions themselves. The unions, one of their main functions is protecting people from arbitrary dismissal. And that's, that's part of the protection they provide. And so strengthening unions is one of the important ways that we can make it less likely that these abusive practices occur. The third is, you might say at a higher level, is creating the right culture. And I think unions can actually play an important role here. When workers go to work, they want to feel that they're doing something positive for society. And when I say positive for society, it's not just getting a paycheck, not just making sure that Wells Fargo sends a bigger check to as dividend to or pays their manager, their CEO an extra multi-million-dollar bonus. That's not what motivates them. What they're motivated is that they're providing services that ordinary individuals need. So I think it's important for unions working with good management, and I think there are a lot of people who are good management here. I don't want to say we're in what is it that are our values, and keep repeating it, because in our world in which money is number one, it's very easy to lose sight of the underlying values.
Joe, when you talk about this, it's worth, I think, bringing into the conversation the fact that the U.S. financial sector, which is the world's largest, I believe it accounts for a third of people employed in the world, is really the only financial sector in a major economy whose workers are not generally in a union and don't generally have the union protections that you were just describing. In fact, it's so little known in the United States that most people are surprised to hear that everywhere else in the world, bank workers are generally organized and have the kind of rights we were discussing. I want to come back, though, to your culture point that you closed with and ask you to talk a bit about the influence of financialization itself on banks and bank culture, and what it's meant that bank CEOs are now largely incentivized, at least in the English-speaking world, with equity, and the difference between people who are sort of shooting the moon with equity and people who are paid a salary, which the typical bank worker is paid, and how these things drive culture.
So one of the complaints of you call it financialization of the entire economy, not just the financial sector, is that over the last 30, 40 years, we've introduced more and more incentive schemes that are short-term and financial. So we tell the managers, the CEOs, the only thing that matters is money, and only money now. So a good illustration of this is the difference between credit unions and the banks. Credit unions are associations of people who get together to provide credit for each other. I think none, or certainly almost none of the credit unions engaged in any of the nefarious practices. They didn't engage in excess risk-taking. They kept their focus on their mission. Their mission was to provide credit for those in the union, to those they were serving. They understood their social function, and it wasn't about maximizing the pay to the CEO of the credit union, or people were on salary and they worked hard. I deal a lot with other countries, CEOs in other countries. CEOs in some of the companies in, say, Scandinavia, big companies that get a fraction of the pay of the United States. And you almost, ask them, how can you, why are you working so hard? Right. And they say, that's my job. Right. And, they say, don't you need a bonus? And
which is a $50 million payout in order to do your job, and the answer is actually no.
No, and they would say the kind of person who says, in order to get off the golf course to work, you need to pay me $50 million, is not the kind of person the company wants. So, I've worked in government. I've seen people work really, really hard. It's not for money. It's because of dedication. They want a reasonable income. So I think this financialization of the financial market where everybody's focusing on how much money do I get out in the short run, has actually been one of the factors that have contributed to both the excess risk-taking and the abusive practices.
You know, it's fascinating, Joe, that people think often of the banks as the people who drive financialization, but to some degree they're actually the objects of it. They're actually, what a bank is has been transformed by the forces of financialization and market fundamentalism and so forth. And we find in the labor movement, when working with bank workers, that what bank workers want is a vocation. They want to be able to do something useful and positive for their customers and to be in an ethical relationship with their management. And it's fascinating how that is become more and more in tension with the way in which the sort of higher level governance of the banks, what they've become. And I think you and I have both had the experience of talking with high level people in banks who are equally uncomfortable but don't know what to do.
Yeah, it is, you might say, they're caught in a net.
Right.
Since every other bank is engaged in this kind of nefarious activity, short-term maximization, they feel if they don't, they're going to lose out in the game. You know, it was put very forcefully in the at the moment of the financial crisis, where one person says, you know, as long as the music plays,
I'll keep dancing.
You have to keep dancing.
It's funny, the guy who said that, who was the CEO of Citigroup, is one of the individuals I was thinking of, whom I know privately was appalled, and he was the CEO of Citigroup, and he literally didn't know what to do. You're raising the financial crisis. I want to come back to that for a moment, and then I think we may have some questions from the larger world to take up here. You know, you and I, in different ways, we're both very much involved in trying to persuade the United States government to act to really alter this system fundamentally during the crisis. The question of whether the purpose of the government response to the crisis should be to sort of patch it up and have this system keep going, or whether there should be really both fundamental reform of the system, but also some accountability, financial accountability, legal accountability, you know, for what happened. I think it's fair to say we kind of lost the argument.
Well, yeah,
I mean, at the time.
We won, let me say, I think we won the hearts of most Americans,
yes,
but we lost the political argument.
But I wondered if you might comment. I mean, I think it's fair to say we're here at the Friedrich Ebert Stiftung, which is a global organization devoted to many things, but I would say, you know, Enlightenment values, I would say, in politics. And there's no question we're in a global crisis of those values. To what extent do you feel that the roots of that crisis go back to the choices made in relation to the financial sector? And the question of whether government is able to be legitimately acting in the public interest in relation to finance. This haunts me, and I wondered if you might say a word or two about it.
So you could answer that in two different ways. I mean, I am very confident that we can write down a set of rules and regulations, structures, institutions that could make the financial sector work. Work a lot better than it is now. You know, the inherent problems of information mean that it will never be perfect, but that's not what we're seeking. We're not seeking perfection here. We're just seeking stopping the exploitation, mitigating the excess risk taking. Okay, so that I think, from analytic point of view, we can do. The hard part is the politics, and I say that because it has become so wealthy that it has a lot of money to spend in lobbying and political campaigns in order to maintain their money. So the system is, in that sense, self-perpetuating. And it's hard to break out of that. That is very worrisome. And I think the only way we're going to do it is a moment like we had at the beginning of the progressive era at the end of the 19th century, where we said, look, our country is moving to a way in which it was all going to be controlled by a few trusts, a few big monopolies, and if we go that way, we'll never break out of it, because they will undermine the democratic process. I think we're actually at that same dangerous moment. Then what we said is we have to break them up. Now I think we have to do more than that. Now we have to say we have to have strong progressive taxes to make sure that there aren't these pockets of money that can be used to buy our democracy and in that sense totally undermine our democracy. We all know we've been going to a system of not one person, one vote, but $1, one vote, and we have to break that.
Joe, I can't resist saying, as you were just listing what you thought we should do, it's exactly the progressive era menu. The national income tax was adopted in 1911. Famously, Teddy Roosevelt said of the estate tax, if you don't have an estate tax, you have a hereditary aristocracy, and you have to choose, and I choose democracy. That was
And
Teddy
he was a
Roosevelt's.
Republican.
Yes, he was a Republican, a particular kind of Republican. We seem so. Now I have been handed a set of questions. We have here at the Friedrich Ebert Stiftung a group of experts that have been talking about these questions today, and several of them have passed on things they'd like you to address. Let me start with a couple of somewhat technical things, and then we'll move on maybe to a broader theme. One of our colleagues asked, when you look at the way the UK responded to the financial crisis and the creation of the ring fencing around their major banks, which was an attempt to sort of separate, just so people understand, an attempt to sort of separate capital markets activity from conventional banking, short of a complete legal separation. Did that have any impact, and should we expect to see any impact from that?
I think it probably did.
Mm-hmm.
I think it would. Let me put it like this. It was important that we separate in one way or another and curtail the excessive risk-taking from the other functions of the financial sector. And that's what that ring fencing was intended to do. It probably has succeeded in the UK. We took a more narrow approach, which was called the Volcker Rule.
Right.
And that was, I think, because they wanted to be more, you might say, precise, it was much more harder to do. And the unfortunate thing is it's being rolled back as we speak.
Yeah.
And so as I compare what's going on in the UK and the US, I say they had the right conception. We'll have to see how well it works and monitor it closely. Banks are notoriously good at circumvention, getting around whatever regulations you pose. And I think we need to recognize that our approach was not adequate to the task.
It's interesting, Joe. This is what a number of people in Congress, led by Senator Warren and Senator Brown, have been talking about when they talk about a modern-day Glass-Steagall, is some way of having something with teeth here. And
they're absolutely right.
Yeah. So, a second question: there's a lot of people who actually work in the financial sector today in the United States are in the business of selling and administering auto loans. And a lot of those people have come to the labor movement and said, we're really uncomfortable with what we're being asked to do in that space. And that conversation has given rise to another conversation that we've started to have, that one of my colleagues wants you to weigh in on, which is, are we seeing a possible source of systemic risk in auto loans, given what seemed like a lot of subprime type practices from 2006 and 2007 that appear to be operating in that market?
It is clear that there is risk that's being created. There were a couple of things about the subprime market that were distinctive. One was that the tranches, the securitization, the role of the credit rating agencies,
the pyramiding,
the pyramiding that took a certain level of bad lending and amplified it. I think we've dampened that down, but whether we've dampened it down enough is one of the questions that one will have to look at, and I'm not sure. Housing is just so much more money than auto loans, that the sheer magnitude is different. And the third thing I'd say is that when we revisit what were the causes of the 2008 crisis, it turns out it wasn't just the subprime; it was the Alt-A loans, a lot of other lending, and particularly by the big banks. By the way, they played a critical role that has not been fully appreciated. So there was a lot more than just the subprime, but the issue that workers in banks, as they issue these auto loans, ought to ask, and regulators ought to be asking, is to what extent are they exploiting those taking the loans? And there are all kinds of exploitations, in some ways easier than in the case of subprime. Getting a foreclosure is supposed to be a more complicated process. We had a lot of legal abuses for which there were very big penalties, the robo-signing and all that. But there's a process that is supposed to be more protective.
Yeah, Joe, I think your point that the idea that the financial crisis in 2008, the mortgage crisis, was somehow limited to some little thing, some little piece of the market, it's very important to keep reiterating that. It quickly became most of the market, the problems.
Exactly.
And because of the impact on the larger economy and unemployment and so forth, it became a problem of creditworthy loans, not just Alt-A, but standard loans.
Exactly.
And I think your point about auto is that people ought to be, regulators and others ought to be paying close attention here, because the collateral is so flimsy fundamentally.
And the potential for exploitation.
Yeah, and it's the poorest people.
It's so easy because people want a car, they need a car, and they don't always know how to calculate. Right, and if you have an exploitive lender, they say, oh, you can easily do a $350 a month loan.
Yeah. Well, not just that.
That's irresponsible.
We know of workers who said that on their screens, when they're selling, when they're dealing with people who are having trouble paying their auto loans, that on their screen comes up a map of where payday lenders are in the neighborhood. Right, which, if you think about it, is just sort of piling exploitation on exploitation as a business model.
Exactly.
And the fact that the worker knows what's on that screen tells you something about information. Let me turn now to a couple of larger questions that colleagues wanted to put to you. We were talking a bit about unions and bank workers and banks, and one of the world's major banks, Santander in Spain, some of their workers in the United States are organizing. Santander is unionized everywhere in the world, but in the United States. And why do you think that's true? Why is it possible for global banks to operate one way, treat workers one way everywhere else in the world, and a different way here in the U.S.?
I guess where I begin the analysis of that is we have different legal frameworks. There's been a concerted effort over the last 35 years to make it more difficult for workers to get unionized, to vitiate their ability to engage in collective bargaining. So I guess it's testimony to the success of those who've been trying to undermine the ability to unionize. They've succeeded.
that might have something to do with why wage stagnation is such a terrible problem in the United States economically.
And worse in the United States than in other countries. One of the interesting things that I look at a lot of different countries, and you can see some of the same forces at play,
Right.
but they play out in the United States in a much more insidious way. So we are the country with the highest level of inequality among the advanced countries. I don't think it's an accident.
And then finally, because I think this question then follows on, if you were thinking about trying to do something about this, thinking about how technology can be an ally of righting the balance of power, one of our colleagues asks about the role that social media, news media, technology that can link ordinary people together, link workers together, can play in sort of building worker voice and the public voice, really more largely, around the question of financialization. And your thoughts about that, maybe some things you've seen as you go around the world that are maybe a little hopeful.
Well, I think that there are, the new technologies are, quite frankly, a two-edged sword.
Mm-hmm.
They are able to bring people together,
Mm-hmm.
To share information. They to increase public awareness of what is going on. And I don't think a lot of people are aware of, for instance, the distinction you just made. Why is it that a bank is unionized in every other country except the United States? The economic function is exactly the same.
Right.
And it's not like the reason they're not unionized in the United States is because we have such good employers that they have no interest in unionizing. It's quite the contrary. So it's not because, say we have such good empathy with our bosses.
It's not like American workers are getting pay raises no one else is getting. In fact,
and
it's
therefore,
the opposite.
Exactly. So it's not that, why would we want unions?
Right.
It's really the legal framework. So being aware of what is going on is extraordinarily important. But there are a couple ways in which technology is working on the other side. The first is the growth of fake news, the growth of the ability of those who want to undermine unions to spread notions that this will be the end of capitalism, this will lead to you'll lose your job, whatever.
Right.
Ideas that have been, ideas that we know are wrong. We fought for a long time, but they can push them back up.
Right.
And secondly, the point that you made, modern technology can be an instrument for more efficient exploitation. Example that you gave of where they link payday loans to auto loans. And it can be the same bank who owns the payday loan. And so the guys in Hawk, they tell them, oh, by the way, you won't lose your car if you go to this payday loan.
Right.
By the way, the interest rate may be 100%, but that's a minor detail. Basically, it's a form of modern day bondage labor.
Right.
And we've created through our financial system what I call indentured servitude or partial indentured servitude. And technology is an instrument in facilitating that, unfortunately.
Yes, this is, I think, why it was so important, when Congress created the Consumer Financial Protection Bureau in the Dodd-Frank Act, that bureau was given the resources and authority to look under the hood in terms of technology, and how hard the banks fought that. and what that told you about what the real game was. Although it's funny, you know, Joe, I consider myself fairly worldly, and I hadn't thought about the fact that that the same bank could own the payday lender or could be financing it, or in one way or another, that it all could be
makes money out of it.
It's all the same thing. Now, I have one more question for you that really is, we're being told we have just a couple more minutes left. One more question that really kind of draws all this conversation into one thing. We're talking today about, in the context of the banks and bank workers and the larger questions about the public interest in banks. There's a concept that's been put on the table of regulation from below, which sort of refers to some of the things we've been talking about, the fact that bank workers have information that the public doesn't have, and sometimes that regulators don't have, that there are ways through unionization, through whistleblower laws and so forth, to give people the space to act. But the larger question is how do you fit, and I think this is really a very good question for you to close on, is how do you think about that set of dynamics and possibilities in the context of what the larger agenda of how the financial system can be reoriented toward what it ought to be doing in terms of financial intermediation, financing productive enterprise, and the role of regulation of all kinds. You have regulation from below, and then you have other kinds of, and then the more conventional kinds of regulation. How, in your mind, do these things all fit together?
Well, I think we have to begin with a vision of what the banks and the financial system as a whole has to do. And let me just say, one of the things we have to always keep in mind is the banks are only one part of the financial system. If you start regulating very closely the banks, but you don't do the rest, it's like it'll squeeze out and go.
Yeah, slips through your fingers. Right?
Yeah, it'll go elsewhere. Right. So you need comprehensive financial sector regulation. And when I say that, it goes to companies like Amazon that may start making loans, anybody engaged in financial activities of that kind. So it has to be comprehensive. And there has to be a comprehensive vision of what is good financial sector activity and what is abusive, bad financial sector activity. And a set of regulations pushing you towards one side and away from the other. Now, in my mind, we talked before, one of the real problems is what economists call capture, political capture. But there's also capture, sometimes economists refer to it as regulatory capture. So I've argued that you need multiple regulatory frameworks, that the malfunction of the financial system is so costly to our society that it really pays to have multiple levels of regulation. The cost of the regulation is minuscule compared to, I've calculated the loss of income from the financial crisis, where we would have been, where we are.
It's gigantic. It's
well over $5 trillion.
Right.
And we're not talking, how many people could you hire for $5 trillion? So the cost of the regulation is minuscule. And I would say the cost is even greater because the financial sector isn't doing what it's supposed to doing, our economy is not growing, even in normal times. So I think given our recognition of these limitations, you want to have multiple institutions involved in regulation, coordinated and looking, but recognize making it more and more difficult to get capture. And part of that multiple regulatory framework is regulation from below. These people in the banks are the ones who see first what is going on. And so we ought to enlist them in this battle. Their interests are in that sense aligned because if the bank goes bankrupt, they're going to lose their jobs. But their interests are aligned because they're ordinary citizens and they want our society to do well and they want to feel like they're contributing to society. So I think regulation from below can be a part of our regulatory system. But the vision has to come from the top.
Joe, I think it's a wonderful note to conclude on, because I think you hit on something that I think animates everything we're doing here today, which is that people who work in our financial system, like everyone else, really want to be involved in something productive and positive. They don't want to be they don't want to feel like their work is being party to a con game. And most people share that desire, and bringing that into play in the overall bank regulatory scheme, as you just described, is good not just for bank regulation, but for the health of our democracy. And that's something we really need right now. And with that, unless our hosts have anything more for us, I think we're going to wrap up this conversation. On behalf of the Friedrich Ebert Stiftung, I want to thank you, Joe, for joining us, and for really, I think, a fantastic half an hour or so, really comprehensively going through some of these issues, and reflecting on, and I'll close on this note, reflecting, Joe, on your decades of work to try to ensure that the global economy works for all of us, for which at least I personally am very grateful.
Thank you.
Thank you.